In development news, 10-storey apartment blocks in a land swap at Fletcher Construction's soon-to-be-developed Three Kings Quarry in suburban Auckland have been rejected by residents near the proposed development. A decision on Fletcher's application for a plan change to allow the development to go ahead is expected in the next few months, and the controversial land swap has been advertised by the council. In a move to bring pressure on Auckland Council to look at other development options for the quarry, the Puki Tapapa local board has hired Richard Reid, one of the country's top urban designers, to come up with an alternative development focusing in particular on better rehabilitation of the quarry and long-term plans for the surrounds. Board Acting Chairman Harry Doig says the council has only considered Fletcher's plan to build up to 1,500 houses on the quarry floor, including 11 apartment blocks, some cascading down the quarry faces with no other alternatives. He argues that's not acceptable. Mr Reid has been asked for an optimum development plan for the whole area, integrating the Three Kings town centre with the Big King volcanic cone, while leaving plenty of opportunity for development. He's expected to come back with a plan shortly. Watchdog community group Three Kings United says if council commissioners approve Fletcher's application for a plan change so the development can go ahead, it will probably appeal the decision to the Environment Court. The advertised controversial land swap is a planned reserve land exchange of 2.7 hectares of Fletcher land on the quarry floor for 2.3 hectares of council land around the southern edge of the site. The council intends using the land for sports fields. At a recent meeting of 250 residents, Chairman Greg McKeon says the land swap only facilitates the development and financial aspirations of Fletcher at the expense of the maunga, ratepayers, the community and users of the Three Kings domain. Community groups in the neighbourhood say they're not opposed to the development of the site, but are sick and tired of Fletcher running roughshod over the community. New Three Kings resident John Bridges says a lot of stark, simple facts are opening people's eyes to Fletcher's planned development. He says the land swap is weighted in favour of Fletcher, no matter how you look at it. This is a development that's cramming high-density townhouses and apartment blocks in a 15 to 18-metre deep hole that Fletcher dug against one of our treasured volcanoes. As the producer of TV show 7 Days, Mr Bridges said he's used to dealing with some edgy jokes, but what Fletchers want to do at Three Kings is beyond a joke. Unfortunately, he says, Auckland Council seems to want to let a company destroy our maunga and a community and just walk away with its profit. What's hard to understand is why the council isn't busting a gut to drive a better bargain for Auckland and better outcomes for Three Kings. Mr Doig says the residents' meeting demonstrates that Fletcher, in conjunction with the council, needs to rethink its development strategy for this area. He says this is probably the most well-attended community meeting ever held on a local issue. The board has been frustrated it's been unable to get Auckland Council and Auckland councillors to look at the wider view and to support us in obtaining an independent report. In takeover news, well, kinda. Analysts are optimistic it's just a matter of time before an acceptable takeover bid for A2 Milk emerges. That's possibly why its share price weakness was so short-lived after A2 said the bid from known suitor, major shareholder Freedom Foods and US-based Dean Foods wasn't acceptable, but the parties are still talking and it has received other approaches. 3 analysts covering the stock have target prices of $1 and more compared with yesterday's market closing price of 80 cents, and all have buy or outperform recommendations. Forsyth Bar analyst James Bassan, the most conservative with a target price bang on $1, gives a successful bid of 50% chance. He says, we believe A2 is more valuable under ownership that can provide distribution across global markets and access to processing assets than in its current form. His discounted cash flow valuation absent a takeover is 82 cents, but 118 with a bid. UBS analyst Jordan Rogers says while he doesn't know what level the Freedom Dean bid and other expressions of interest are pitched at, we believe that any takeover offer for A2 would likely have to be in the low $1 or higher to have a chance. Mr Jordan's current target price is 105, up 10 cents on the back of A2's latest guidance, although his discounted cash flow valuation is 121. First New Zealand Capital analyst Ka Yu says the company is worth more to larger operators than it is on its own. Mr Yo says the potential margin upside gained from operating leverage through a higher processing utilisation rate and pre-established supply chain logistics of larger operators could be very significant. He's the most optimistic with a 117 target price, and his valuation ranges from just 88 cents through to 224, depending largely on how A2's rollout in the US pans out. The top end of his valuation is what he thinks the stock might be worth to a highest value owner, not what a bidder might offer. Mr Yo says we think the current risk reward in A2 remains compelling. He also rates the chance of a successful takeover at about 50%. To Canterbury, Huranui Water Project in North Canterbury is seeking new capital as local farmers struggle with the aftermath of drought and falling international milk powder prices. HWP wants to raise $1 million from outside investors so it's eligible for a dollar-for-dollar Government Irrigation Accelerator Fund subsidy. It's blaming delays for the project on the 2010 Environment Canterbury Act. Environment Minister Nick Smith introduced the legislation to legalise the removal of elected councillors and installation of commissioners to speed up water management projects. A fortnight ago, he declared a return to a half-elected, half-appointed council in late 2016 because he said it was too important to risk the progress made by commissioners. HWP Chief Executive Alex Adams says the project has been hampered by unexpected and extraordinary delays due largely to the changing legislative and regulatory environment over the past 7 years. Mr Adams says while it's undoubtedly great for the long-term freshwater management of New Zealand, the timing of new policies and regulations, including the introduction of the 2010 Environment Canterbury Act relating to improved water management and the introduction of nutrient load limit regulations, has caused unanticipated delays to this particular project. Shareholders have invested $10 million in HWP. The company, 30% owned by Ngāi Tahu, is behind the proposed multi-million-dollar Waitohi irrigation scheme. Mr Adams says our farmer shareholders face compounding challenges with drought and lower dairy returns, so external investment is now required to allow the scheme to proceed to the next important phase. The scheme had 9 consents granted in 2013. 2 appeals were lodged and are awaiting a final Environment Court ruling following a mediated agreement in February this year. Part of the hold-up in signing off consents for the project involves finalising agreements on nutrient and phosphorus leaching in the catchment to satisfy proposed dairy conversions as well as existing dryland farmers. Meanwhile, the drought in North Canterbury appears to have forced at least one mortgagee sale near Greta Valley, advertised by Bailey's.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
NBR Radio, Friday the 25th of July. I'm Andrew Patterson, and with me, as always, for our political and economic week that was, Rob Hosking. Rob, very much the economy front and centre. The Reserve Bank, not surprisingly, cutting the OCR. But this week now, very much the politics of the economy.
Several things happened this week which do point to a slowdown or a softening, to use a term that the Reserve Bank used. And it's really important that, and I've talked about this earlier and certainly written about this, that we don't talk ourselves into a recession. There's certainly a slowdown coming, and mostly it is through that dairy price. We've seen a very large drop in the dairy price since early last year, and it does look, as the government acknowledged this week, that the dairy price is going to drop further than what was thought even a month ago, and that's global factors pushing that down, extra supply coming on, and that having an impact on price. Coupled to that, of course, is what looks like a bit of a slowdown in China compared to the growth they've had in the past, but they're still at or around 7% growth. Our own GDP growth, there's the forecast we had from both Treasury and Reserve Bank only sort of six to 8 weeks ago were for 3% GDP growth on average over the next 3 years. Nobody expects that now. We're looking at coming down towards 2%. Maybe we'll dip a little bit lower than that. But I think any suggestion that we're going into a recession, which a lot of people, some people seem to be implying, is the figures we're seeing, the hard figures, and that includes everything from the non-dairy parts of the agricultural sector to net migration, suggest that's just we're not going to dip into a recession unless we get an economic or financial bow wave from somewhere else.
National Party conference this week, obviously they'll be using that to pump the message that things are steady as she goes.
Yeah, I think it'll be a message of we know how to get through slightly harder economic times. This is a government that did come in the middle of a very big crisis, and I'm a bit of an economic historian, and I've actually written about previous economic shocks like the one we had in 08, 09, and how for some reason, these shocks seem to coincide in New Zealand with changes of government. And, you go back to 1957 and the shock that happened then in the Black Budget in 1958 through to various other shocks we had. The more well-known ones are 84 and 91, but there were also a couple of others in between times. And when you compare to how previous governments have handled downturns, this one has actually been remarkably astute. They didn't hit the panic button and sort of hit all the levers at once just to see what would happen, and they didn't try and spend their way out of it either. It was quite a measured approach. And I think politically, National has reaped the benefits of that. But I think the question now is, and this has really been the political question of the last 18 months, is what are you going to do for us next? And whether, the last year's election was the first post-GFC election. And I think really it was, okay, what do we do to take us to the next step? And really, despite the election result, I don't think National really properly answered that question. And I think they still haven't. And we may get something this weekend. I have my doubts, but we'll have to wait and see.
I was talking to somebody this week, influential, and they made the comment that they still find it hard to believe that given this government's popularity, and particularly around the PM's personal popularity, that the government seems unwilling to take risk, to really power up things and take advantage of this somewhat unique position that would be the envy of almost every government that we've ever had in this country.
Yeah, I think they are very, very, very cautious. They're very focused on. They've taken a lot of lessons from John Howard in Australia. They really did study how Howard managed to last for so long there, and Key and Howard have talked about this a lot. Apparently, Key mentioned sort of in passing at the end of an interview I did with him about a month ago, and it's what the Aussies call the battlers, and it's very much that West. The stereotypical vote is that West Auckland vote. People on their first mortgages or about to get into their first mortgages. And that's, those, and look, that's not new either. Certainly conservative governments here and around the world, to stay in power long term, they've had to get those what Thatcher got what they call the C2s, which were those skilled manual workers who wanted to better themselves, and she got those on board. They voted Conservative. In fact, stronger than some as a group, as a voting or as a socioeconomic group, more so than people further up the socioeconomic scale, and because they thought she offered a future, and that's really what has kept Key and his party to a lesser degree very much on board. I think National's long-term question politically, just for them as a party, is the issue of how much the brand of the party has become brand Key, and how where's the succession plan here? Because he's not bulletproof, and no one, very few people. We've had a couple of 5-term governments in this country, but you've got to go back to the 1920s for the last one.
Yeah, and of course, things can change so much more quickly than perhaps they did before. The other issue that was interesting raised this week, what's been termed the relics. These are the government assets that they really don't know what to do with because they're beyond selling, and they're kind of stuck with them, including TVNZ, Kiwi Rail, New Zealand Post, and obviously Radio New Zealand as well. And potentially, Rob, there could be more relics added to this category with the energy sector in the future.
Yeah, it was an interesting comment from English. He has these bursts of unusual frankness, and this was one of them. And they are SOEs which modern business world is passing by. Kiwi Rail is a big one. They've poured $2 or $3 billion into Kiwi Rail, and it's still making losses. You've got Radio New Zealand, which is trying to manage some sort of transition, but I don't think they quite know what to yet. And even if they do, Radio New Zealand isn't actually all that good at transitions. And you've got NZ Post, which is battling with the fact that people get everything from bank statements to I don't know,
Sky bills,
things. Yeah, all those you get them in your email now, which are a lot damn sight safer anyway. And so you've got the 3 deliveries a week now. TVNZ, the free to air sort of broadcasting is a bit of a it's becoming increasingly dinosaur territory when people are getting watching their programs on YouTube.
Rob Hosking with our political and economic week that was here on NBR Radio.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
To the TPP, the Labour Party is giving conditional support for the controversial Trans-Pacific Partnership, with Party leader Andrew Little saying Labour is pro-free trade but will only support TPP if it contains key protections for New Zealanders. He said Labour supports free trade, however we will not support a TPP agreement that undermines New Zealand's sovereignty. The Labour caucus had agreed 5 bottom-line principles. The government's drug-buying agency Pharmac must be protected. Corporations cannot successfully sue the government for regulating in the public interest. New Zealand maintains the right to restrict farmland and housing sales to non-resident foreign buyers. The Treaty of Waitangi must be upheld, and there must be meaningful gains in tariff reductions and market access for New Zealand farmers. International Trade Minister Tim Grosser has repeatedly given assurances without detail that these conditions will be met, but the secrecy surrounding the talks and leaks of draft negotiation documents have fueled fears about the pact, which covers investment as well as trade rules and has become a legacy issue for US President Barack Obama, who was forced to rely on opposition Republican Party backers to gain authority to fast-track an agreement through the American political system. Mr. Little said in a statement, the lack of transparency around the government's negotiations with large foreign interests means Kiwis are in the dark about which of their sovereign rights are being gambled away by this government in the hope of better trade conditions. He said Labour is pro-free trade as evidenced by the China Free Trade Agreement we signed in 2008. But by negotiating the TPP in complete secrecy, the government is creating a level of public unease. Releasing detail of the agreement after negotiations are complete was too late to guarantee protections on some of our most valuable institutions and rights. Mr. Little said this is not good enough, and it's not enough time for New Zealanders to ensure their interests are being protected. The bottom line for Labour is that New Zealand's sovereign rights must be protected. Anything else is unacceptable. Trade ministers are due to meet in Hawaii next week for what's expected to be a crucial set of talks if the TPP agreement is to be advanced at a pace that keeps it out of the firing line in next year's US presidential elections, where concerns about the impact of its provisions on American jobs has made Democrat and Republican candidates alike nervous about its political saleability. So let's talk NBR on NBR Radio. NBR Online is now reaching an audience of 104,000 people as tracked by Nielsen's online rating service for June 2015. Nielsen's digital measurement hybrid methodology uses data from both a people panel and server-based tags. In January this year, it found NBR Online had a unique audience of 71,000. In February, the figure grew to 83,000, March 93. Momentum has continued with the audience pushing through the 100,000 mark. NBR's online audience has been fueled by growth in IP or organisation-wide subscriptions. There are now 348 IP subs, with recent arrivals including Tainui Group Holdings, the Department of Internal Affairs. Interest has been stoked by a number of new initiatives at NBR Online. The website had a major makeover in October, delivering a cleaner look, a responsive design for mobile and more customisation options. This year has seen the introduction of My NBR Radio and the on-demand My NBR Radio, plus new initiatives like the recently introduced keyword email alerts for keeping tabs on specific companies or people. NBR's newsroom has also been expanded with new hires, including Tim Hunter and Jenny Ruth. Things are likely to keep heading north. Next week we'll see the release of NBR's annual Rich List, which is typically the publication's highest rating online event of the year. To Christchurch, developers of iZone Business Park at Rolleston, 20k south of Christchurch, say they're 2 years ahead of schedule. They're now launching the next planned stage of the 180-hectare development. One of the obvious reasons for the success of the park are the prices. A price list obtained by NBR shows lots being advertised for $125 a square metre up to $160 a square metre. According to an industrial specialist, Greg Mann, the price of similar land closer to the city at Wigram is $300 to $350 a square metre, and at Hornby, $225 a square metre. Mr Mann has just moved from NAI Harcourts to Bailey's, where he will continue to specialise in industrial leasing. But he predicts the market for development land will ease off, given the large amount of rezoning and development since 2011. Meanwhile, iZone is releasing 17 lots over 41 hectares, one of them sold. They're located opposite Port of Tauranga's 15-hectare freight hub Metroport Christchurch, which opens shortly. Littleton Port has also bought 27 hectares with plans for a similar freight hub. iZone is owned by Selwyn District Council and is currently home to more than 60 businesses, with more scheduled to open in coming months. Another way Selwyn District has undercut its city rival is by waiving development contributions, which often represent a major component of new project budgets. Although Selwyn District is a party to the Greater Christchurch Urban Development Authority, set up to coordinate sprawling development and transport, it competes with the city and has proved more nimble at consent processing in the post-earthquake era. The GCUDA continues to sit at the Christchurch civic offices, although its purpose is less clear, and it appears to mainly accept duplicate council reports on such things as transport, land use reviews and other planning reports.
NBR Radio. With Hotel de Brett, your home away from home, but with better service. NBR Radio.
Friday the 24th of July, I'm Andrew Patterson. This is NBR Radio. The sale of one of the two most important business publications in the English-speaking world has itself created news. Japan's Nikkei company has bought the London-based Financial Times in $1 billion-plus deal. In his editor's insight today, Neville Gibson examines the implications. So, Neville, did the Japanese get a good deal?
Well, some people will pay anything to get what they want, and that was the case 8 years ago when Rupert Murdoch paid $5 billion for the Wall Street Journal. In other words, it's 4 times what the Japanese are paying for the Financial Times, and those are the two large global newspapers. Murdoch had a hostile bid in there, and he paid well over the odds, and in the play Rupert that's been on in Auckland recently, they said it was a payback for an unflattering story the Journal ran about Wendy Deng, but I think more likely is that Murdoch had that ambition in America to rival the New York Times in both quality and also shift the political influence to the right, and certainly the Journal was a pretty good fit for his views. As far as that deal goes, in 2009, News Corporation had to write down the value of the Journal by $2.8 billion. So he paid twice as much as what the Japanese are paying. They're paying something like 35 times the earnings of the Financial Times group, but Japanese have never seemed to be worried about getting a very high return for their investment.
So what do the Japanese get for their billion odd dollars, apart from what is obviously well regarded as a very high quality publication?
Well, they certainly don't get a cash cow, though newspapers are fairly steady in their decline at the moment. Newspapers like to measure their circulation these days by combining it with the digital readers and subscribers, and if you do a comparison between the FT, it's got around about 700,000, and the Journal's got 1.2 million, so more of those people are paying for digital. And as I say, the profit's pretty low, but the FT has a kind of mana around the world. It prints in a number of places. It's just as global as the Journal, although they don't overlap in places like South America, but they certainly do in Asia. But the FT is running well behind the Journal in Asia. If you look at, I was in Poland recently, and the business newspaper there is in pink, but it's not part of the FT group. They did have a big title in Germany, but that failed. But anywhere you go, India is another place where you see business newspapers in that pink colour, although not directly owned by the FT.
Yes, it has been the distinctive marketing feature of the FT, the salmon-coloured paper. What do you know about the Nikkei itself?
Well, people, apart from it's got the main share market index, but anybody who's been around Asia will see the Nikkei weekly comes out in English. They syndicate a lot of news in English, their websites in English, but they are also twice as big as the Journal in terms of circulation. In other words, they are the largest circulating financial newspaper in the world, so 3 million Japanese buy that. It's obviously quite an influential publication. Nikkei's been expanding lately, actually. It's just bought a shareholding in Monocle, that trendy magazine that won't go online and is pretty much favoured by people who like travelling and design and that sort of thing. And it certainly sees big room for expansion in its English language website, and no doubt they've been thinking about this. But the sale was rumoured earlier this week, and suddenly there was a bit of excitement, and everyone thought the Germans, Axel Springer, was going to buy it. But apparently the Japanese came in at the 11th hour or the last minute and paid the top dollar.
So why did Pearson appear ready to sell what is obviously a highly regarded asset?
Well, if you go right back in history, all of the publications I've talked about, the Financial Times, the Wall Street Journal and the Nikkei Journal, which was originally the house journal of the Mitsui Company, all started in the 1880s when share markets became quite popular and people needed that financial news. But Pearson, which bought the Financial Times back in I'm not sure what year, it was 1945, somewhere around about there, has basically been a big educational publisher that still provides £5 billion worth of its business. There's a lot of trouble in America, so the chief executive has been looking around, and the sale of the FT came to the fore there. So they're going to focus on their educational publications. And just a couple of years ago, they merged the Penguin books, which was the other big interest, with their biggest rival, Random House, to form the world's largest book company. And they've still got a 60% interest in that company. So the FT is not going to run out of money anytime soon.
Yeah, the Pearsons do produce a lot of textbooks, don't they? That's another area that they're...
Well, that's the education and textbooks is now their core business. Anyone who reads The Economist knows that Pearson owns half of that. That's not part of the deal, so that's going to stay in there. Plus, they get to retain that big FT headquarters just over Southwark Bridge.
All right, and just finally, Neville, has Nikkei explained the reasons for the acquisition?
Well, the chief executive was interviewed a while ago in English, and that was published on another website I found, and he says that they are trying to aim for a much bigger coverage in Asia, but of course the big footprint they're going to get is that the FT is very strong in North America. While it's not as big as the Wall Street Journal for obvious reasons, it is much more of a global newspaper in the sense that it's got very large American circulation, as indeed has The Economist. So if you combine growth in Asia and a footprint into the US market, that's where the Japanese want to be.
Thanks for joining us, Neville Gibson, with his Editor's Insight on NBR Radio.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free, and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
Legal matters. Listed investment company Pine Gould Corporation is promising a vigorous defence of Cayman Islands legal action brought by New Zealand government co-investors in its Torchlight Fund. This week, NBR revealed Crown Asset Management and ACC are parties to a lawsuit filed in the Grand Court of the Cayman Islands seeking liquidation of the $250 million limited partnership. Alongside an Australian investment fund, they say they've lost trust and confidence in Torchlight's management, run by a PGC subsidiary and its controlling shareholder George Kerr. In the court petition, the investors, who collectively own an 89.9 million Australian stake in Torchlight, claim the fund's manager is acting in a manner prejudicial to the interests of the limited partners. In a statement to the NZX, PGC said the Torchlight Fund is vigorously defending itself in the Cayman's action, which it described as an ill-considered and meritless action which has no prospect of success. It said it would not be commenting on the detail of the claim as the matter was before the courts, but pointed to the long-term nature of the partnership investment. It said a small number of limited partners are seeking early exit from the TFLP partnership and liquidity for their investment. They're petitioning to have TFLP wound up prior to fund termination date. The legal action has potential for a significant effect on PGC. A big part of its operating income is from the fund's management fees, and it has a 27.8% stake in the fund in its own right, valued in its accounts at £30 million. It's understood that the costs of the court could also be borne by PGC if it loses. Although the fund indemnifies the manager for court costs, it looks as though that money may have to be repaid if the court finds it breached its duties. Crown Asset Management and ACC acquired their holdings through their involvement with South Canterbury Finance, which had borrowed from Torchlight in exchange for investing money back into the fund. The two companies are believed to have $30 million and $2.25 million respectively at stake in Torchlight. The wind-up petition has also been supported by New Zealand entities Public Trust and Logic Fund Management, which have a collective 5.6 million Australian invested. Market news. Australian fund manager L1 Capital has cashed up its stake in local telecommunications network operator Chorus, booking a 34% gain over the past year. According to a notice filed with the stock exchange, the Melbourne-based firm sold 7.9 million shares for 19.7 million Australian on July 22, an average price of about $2.48 per share, and reducing its stake in the dual-listed Chorus to about 3%, which is below the 5% threshold that makes it a substantial shareholder. L1 bought 6.4 million shares for 11.8 million in August last year, an average price of $1.85, which lifted its holdings to 5.03% of Chorus. The shares were down 0.2% at 2.835 on the NZX and last traded at 2.59 Australian on the ASX. L1's 34% return from the sale compares to an 11% gain in New Zealand's S&P NZX All Index and a mere 1% increase in Australia's S&P ASX 200 Index over the same period. An Australian equity investor lifted its stake in Chorus after the network operator had been upgraded to a buy rating by UBS analysts, who expected the company to retain its fundamental value as it emerged from the regulatory cloud looming over it. Earlier this month, the Commerce Commission retained its view on how much Chorus can charge retailers for access to its regulated copper line service, while changing its mind on whether to let the network operator backdate changes to its prices, which would see its biggest customers, Spark New Zealand and Vodafone New Zealand, have to fork over the difference. The regulator will make a final decision in December. Let's talk rates. Rates campaigner David Thornton wants local government minister Paula Bennett to look at scrapping council rates and replacing them with a property value tax or PVT, where increases are limited to 2% a year. The former North Shore councillor has written to Ms Bennett asking her to investigate his proposal, in which annual tax charges would be by way of a transparent percentage based on the new PVT. Changes in value would only occur on sale of the property or additional building which adds value. He says real estate agents would not be able to use the new PVT as an indication of market value, which is the current and often misleading practice. Mr Thornton, who founded lobby group No More Rates, says Aucklanders angry at huge rates increases need to look deeper than simply blaming council spending and waste, although both do impact hugely. He says the killer in this year's wide variation in rates bills is the general property revaluation that took effect at the beginning of the month. Added to this is the financial year of converting to a single rating system across the whole of the supercity, he says, plus the transport levy imposed as a fixed charge. In another 3 years, he says, there will be another property revaluation, which will inevitably bring wild variations in rates bills again. Only a change in the valuation process will stop this continuing 3-yearly fluctuation, bringing anguish and concern to residential ratepayers. His proposal is based on Proposition 13, introduced by California in 1978. It survived despite many attempts to change it. Mr Thornton says since 1978, more than half of all states in the US have introduced similar systems aimed at giving residents some meaningful control over local government taxation and expenditure.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio, Friday the 24th of July. I'm Andrew Patterson, and with me, Labour's corrections spokesperson Kelvin Davis. In light of the revelations that have been made this week about Mount Eden Prison, where do you believe this leaves the credibility of the Serco contract?
The Serco contract, the whole private prison experiment's just been an utter failure. And to me, the contract should just be ripped up and Serco kicked for touch.
Was this always going to be a problem for the government, or on the face of it, is there more to the story than perhaps has emerged at this point in terms of, I guess, the management of the contract?
Look, I think if you look at international research, that what we're seeing here in New Zealand is exactly what's happened overseas, and the government knew this. I mean, and Serco itself has got a dodgy reputation in the United Kingdom and Australia and at Mount Eden now, and I'm sure that stuff is going to emerge from Auckland South. So they should have read the tea leaves and just never even gone there with Serco. And I've read research around other private prisons, and they're saying the same stuff. It's just an utter failure. They have to cut corners. They have to, reduce staff numbers to make ends meet. They don't report. It's not in their best interest to report incidents, so that they don't get financial penalties. I mean, we saw that with the riot that occurred last year in May. They downplayed the incident so that they didn't get a $100,000 fine. This is just what happens when you have private prisons.
With the specific issue, though, it seems both sides of the House have been asleep at this one, because the story ended up being broken by 3 News. So Labour wasn't able to even be any more aware about what was happening than the government was. Well,
I've had letters from prisoners since I've been a corrections spokesperson saying that this has happened to me and that's happened to me. And I've sent them off to the ministers, for basically say, well, what's happening here, and can you address this prisoner's needs? People just generally weren't interested in prisoners getting beaten up, because the general thought is, oh, look, they're in prison, they're bad people, leave them to it. It wasn't until we actually saw this stuff coming out that it sort of just confirmed what we'd known, and more stuff is just coming out now. Now that it's out there, it's just rolling in. There's a tsunami, there's an avalanche of disclosures, and it's just horrible. I think actually the prisoners, to an extent, didn't ever really feel that they had a voice and that they would be believed. But, now it's the cat's out of the bag, and Serco has to go.
Is there any doubt about that in your mind? Or, the government will certainly not get rid of this contract easily.
Well, there's no doubt in my mind that Serco has to go. What the minister does is anyone's guess. I think he's meeting with Serco now. They had to please explain yesterday. The Serco said, oh, look, we'll sort it out and everything will be fine. And then a couple of hours later, there was another disclosure about an inmate who had been transferred from Mount Eden to another facility, and he was damaged goods as well. So, I don't know how many more of these stories we have to hear. The other thing is that Serco haven't been forthcoming with the information with all the incidents. So, it was hard for us to actually jump up and down about it when we weren't aware of the extent, because they were hiding stuff from us.
So why?
And the other thing is that they're not. We can't really go through the OIA process because they're a private company, and so it's just a way of hiding a lot of bad stuff. Is
part of the problem here? While there may be faults on Serco's side, that the process itself actually hasn't worked in terms of the transparency of the reporting and the various aspects of the management of this contract seems to have been as much at failure as Serco's operational side of the prison itself.
Yeah, look, I don't know the contractual stuff and all that. I'm not privy to that information. But from my point of view, the ROS starts at the top and it's just working its way down. And, you can't really blame corrections officers. They're working under the conditions that they're working under. They can't speak up about the low staff numbers on units. My cousin was a corrections officer up north, and he said that their ratio was 1 officer to 15 staff. At Serco, I believe it's 1 to 50 or 1 to 45, 1 to 50. And if any Serco officer complains about that, that it's just not in their best interest, and their career, might be a bit short. So, there's operational issues. There's the management of the contract. like I say, it started at the top, the rot did, and it's just spreading throughout the whole system.
Is Labor fundamentally opposed to any of these privatisation arrangements?
Yes.
And so if you were to win government, there would be none of these type of attempts to bring the private sector into government areas.
We would not be looking to bring private operators into the system. I mean, we believe it's the Crown who denies people their liberty. They, commit a crime, you lock them away. That's the Crown has done that, and the Crown has the responsibility to look after those people when they're in prison. And it's not to say that prison has to be a holiday park for them, but it's the Crown's responsibility to house them, rehabilitate them, and all that sort of stuff. But this is New Zealand. It's not Guantanamo Bay. We can't have this sort of stuff going on here in our country in 2015.
Thanks for joining us, Kelvin Davis, Labour's corrections spokesperson on NBR Radio.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
To Christchurch. Christchurch may not have its new conference centre yet, but it continues to host conferences in several venues. It's just won a bid to host the 2018 Steel Structures and Seismic Areas International Conference. Christchurch and Canterbury Convention Bureau and Tourism New Zealand Business Events made a successful bid, which was presented by Dr. Gregory McRae from the University of Canterbury at the 2015 conference in Shanghai last week. The three-day conference, held once every 3 years, will attract roughly 300 mostly international delegates to Christchurch in February 2018. The venue is yet to be confirmed, but organisers will use either the Air Force Museum at Wigram, the transitional cardboard Anglican Cathedral, or Ridges Hotel in Latimer Square. Each has capacity for 300 delegate conferences. Dr. McRae says New Zealand is well known for its earthquake engineering and low-damage construction techniques, and Christchurch has a wealth of experience to share with international researchers and practitioners in this field. The Department of Civil and Natural Resources Engineering at University of Canterbury has gained worldwide recognition for its extensive theoretical and experimental research in the behaviour of steel structures. Dr. McRae says Christchurch is a living classroom and a rare example of a city where we have both steel structures and earthquakes. He says we'll be able to tour the city talking about the practical issues and a first-hand experience to help advance global research about seismic design of steel structures. In media news, Pearson has announced it will sell FT Group for £844 million to Japan's largest financial news company, Nikkei. The cash sale shows Pearson is continuing to focus on its education publishing business, which accounts for about 75% of its revenue. The Financial Times says Nikkei's 11th hour offer for the London-based global news organisation managed to beat Germany's Axel Springer. The iconic pink newspaper says Axel did not know it had been beaten until 15 minutes before the deal was announced. Pearson has owned the Financial Times for almost 60 years and generated about 6.8% of its revenue from FT Group. Former Pearson Chief Executive Dame Marjorie Scardino, who ran Pearson for the previous 16 years before 2013, once vowed that the FT would be sold over my dead body. Her successor, John Fallon, who took over in January 2013, was more prudent, describing the FT as a highly valued part of Pearson. Mr. Fallon says we've reached an inflection point in media driven by the explosive growth of mobile and social. In this new environment, the best way to ensure the FT's journalistic and commercial success is for it to be part of a global digital news company. The agreement doesn't include FT Group's London property at 1 Southwark Bridge or Pearson's 50% stake in the Economist Group, but does include its joint venture in Vedomosti, a Russian business newspaper. The deal is subject to regulatory approvals. Shares rose 2% shortly after the deal was announced, and several analysts told the Wall Street Journal it was a sensible move.
NBR Radio, Friday the 24th of July. I'm Andrew Patterson, with me Hamish McNichol. Hamish, you've been following this stoush between the two rich listers with the common driveway, and I see the whole situation is now being described as without precedent in the common law world generally.
Yeah, this is quickly becoming one of the more expensive gates you'll probably come across. Basically, Cam Gregory, who is the former Metropolitan Glass founder, wants to put up a gate on a shared driveway with former Advantage Group chairman Evan Christian, who's a former rich lister, but still owns a few multi-million-dollar properties, so still certainly doing very well for himself. But basically the situation here is different. There's hundreds of cases, as Justice Sarah Katz described in the High Court of Auckland on Thursday. There's hundreds of cases of someone putting up a gate and then people going to court to get a gate taken down. In this case, though, there was a gate there, and then when Mr. Christian moved in 2013, he took the gate down, and so the order is to try and get it put back up. So basically a lot of yesterday's argument was Mr. Gregory's lawyer, Harry Wilkins, QC, trying to say that there's a case here that needs to be answered, but as Justice Sarah Katz said, and both counsel were pointing to, there's actually no common law case of this type in the world anywhere. So it's actually, while it's just an interesting story of a squabble between some very wealthy individuals, it's also potentially going to have implications for common law and for right-of-way easement issues broader. So
yes, law students around the world could be studying this as a precedent case.
I suppose so. Yeah, it's still. Yesterday they're fighting for an injunction. They're trying to basically get it to go to a full trial. So we'll still yet to see whether it'll get that far. But certainly if it does, then as it stands, no one's been able to find any precedent for this, so it could set a new precedent. And basically the thing is that the way that the easement is set up is that they both own, or notionally own, half the driveway between them, and it's split down the middle. And so why it's so unique is because Mr. Gregory is trying to get a court order for him being, what's the term? He is the dominant tenement. And so he's trying to get a court order to be allowed to put a gate on someone else's land effectively, which is what makes it so rare and unique. But yeah, a couple of Queen's Counsels involved, few court dates already, so it's quickly becoming very, very expensive.
And the problem with this is you can't really have half a gate, can you?
No, that's the thing, is that, that's why it's notionally cut in half, because without the other half, each half would be useless. It's a good 7 metres wide, apparently, but even so, if you've only got a gate on half of the driveway, then it's really not going to do its job. And there's a fourth homeowner involved with all of this, because Mr. Christian actually owns the home at the front of the driveway as well. But there's a little unit, or not a little unit, it's worth $2 million, but a unit at the back of that home, owned by a fourth guy who was recently broken into, and he's backing Mr. Gregory's want for the gate to be put back up. So, interesting little case, this one.
Has there been much explanation about the nature and the reasons for the gate, and why one wants the gate and clearly the other doesn't? Because you would think, actually, that rich listers do like their privacy and their security, and that they'd all be keen on a gate.
Yeah, exactly. And there was actually a line from Mr. Wilkins, Mr. Gregory's lawyer, yesterday, that Mr. Christian does actually want a gate. He just wants it further down the driveway, which makes it seem even all the more ridiculous. But yeah, like I say, it's still reasonably early stages, but for whatever reason, the gate at the top of the driveway, one of them didn't want it, took it down, and the other one does, but they both effectively own the land, and so it's an interesting little case.
The other aspect of this, Hamish, apart from being a potentially precedent-setting legal case, this is going to end up being a very expensive gate.
Yeah, precisely. I mean, the homes are Mr. Christian's two homes. One of them's worth $8.65 million, and then the one closer to the road is $1.825 million. Mr. Gregory's is $3.75 million, and then the fourth homeowner who got burgled recently is $2.05 million. And I mean, the gate was already there, so to take it down and then have to put it back up, but fighting with Queen's Counsels through the High Court system is going to make it very expensive indeed. Any
idea as to what the estimate on legal fees paid so far would be?
Oh, I'm not sure, but I don't imagine it's cheap.
No, Queen's Counsels don't bill their time in double-digit figures, do they? All right, thank you for joining us with that. We follow the case with interest. What's the next phase from here?
Basically, we'll wait to hear what the decision is on this injunction, and then from there it'll either go to court or no doubt it'll be appealed or whatever. So just keep an eye out for the next date, basically, from here.
I was going to say plenty of water to go under the bridge, but some sort of metaphor relating to gates might be more appropriate. Thanks for joining us. Hamish McNichol with us on NBR Radio.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
Let's talk prisons. Labour's corrections spokesman Kelvin Davis has applied more pressure on the government to give Serco the boot. This follows Mr Davis tweeting earlier today that Serco is entitled to $1.2 million in performance-related bonuses. Mr Davis tweeted, "I say give it to the people who've been abused in Serco's care." Mr Davis told NBR Radio the private prison experiment has been an utter failure in New Zealand. He says the government should have known better, as Serco has a dodgy reputation overseas. He says the government should have read the tea leaves and never even gone there with Serco. He says Labour is fundamentally opposed to any privatisation agreement, and if the party were to win government next election, it would not bring any private operators into the system. He says we believe it's the Crown who denies people their liberty, and the Crown has the responsibility to look after those people when they're in prison. This is New Zealand, not Guantanamo Bay. We can't have this sort of stuff going on here in our country in 2015. Corrections Department boss Ray Smith says he will announce a decision about Serco's contract shortly, following a meeting with Corrections Minister Sam Lotoinga today. Mr Lotoinga has been under fire since revelations of a fight club and other unsavoury activities revealed in Auckland's Mount Eden prison. After a Please Explain meeting with Serco bosses, Mr Lotoinga told Parliament he was not made aware of other incidents or attacks at the prison. But Mr Davis says he's received letters from prisoners informing him of multiple instances at the prison and says he sent the letters to Mr Lotoinga. He said Serco has not been forthcoming with the information with all the incidents, so it was hard for us to jump up and down about it when we weren't aware of the extent because they were hiding stuff from us. He says it's difficult to get a clear picture of what's happening because Serco is a private company which rules out an OIA request. In today's NBR print edition, struggling flooring retailer Carpet Cord is to be sold off to an Australian private equity fund, reportedly with no crumbs left for its shareholders. Farmer efforts to promote a meat industry mega-merger look too little too late as the Silver Fern Farms board mulls several formal transaction proposals from overseas investors. Further interest rate cuts are on the way as Reserve Bank Governor Graham Wheeler signals a less rosy outlook. Rob Hosking assesses what the risks to the economy are. Scaffolding should start appearing on Auckland's former Reserve Bank building next month as its stalled conversion gets underway again. Sally Lindsay reveals the Custom Street site will now be transformed into 2 hotels. Independent valuations ordered by the Commerce Commission are the sticking point delaying its decision on the proposed merger of New Zealand's 2 remaining wool scourers. Neville Gibson writes in Margin Call investors can be forgiven for feeling somewhat bipolar given recent world events. Lessons are available from across the Tasman to decide what, if any, rules and restrictions should apply to foreign property buyers. Farmers are facing unprecedented market volatility, which is creating pressures that could be alleviated by government action and support. Meanwhile, Tim Hunter says cow cockies have had us fooled for years as he takes in the record low dairy prices. All this and more in today's National Business Review, out now. In dairying news, Waikato Tainui wants to diversify its expanding property portfolio and is not ruling out buying more dairy farms amid the current downturn in milk prices. Sir Henry van der Hayden, chairman of Tainui Group Holdings, or TGH, the branch of Waikato Tainui which manages the tribe's commercial assets, says, "We're very much a property-oriented business and our strategy in the medium term is to be a more diversified entity." The former Fonterra chairman says this will deliver more cash, more jobs, lower risk, as well as growing the tribal estate as far as land is concerned. He says we want to run a more diversified portfolio that includes fixed interest, primary industries, that includes land. Sir Henry says new shareholdings in Waikato Milking Systems, GoBus and Genesis Energy have been a highlight of the past year, with all 3 providing strong returns from day one. He said they're a good start, but we've a long way to go to achieve the balanced portfolio of investments that we're seeking from our diversification strategy. Asked if the diversification strategy included buying dairy farms, Sir Henry refused to rule that out. He said, "I'm not going to say yes to that. It's moving from where we are today, which is very much around property. It's the majority of our portfolio." Some 67% of TGH's assets are in property. TGH is reporting total assets of $875 million, up $53 million on last year, and a net operating profit of $35.6 million. The chairwoman of the tribe's governing entity, Te Kauhanganui Maxine Moana Tuwhangai, says overall total assets now stand at $1.2 billion, up $123 million on its 2014 position. Net operating profit was $26.1 million, up from $22.6 million the year before, with TGH and Waikato Tainui Fisheries reporting a combined dividend of $12.5 million, down from $13.9 million last year. Sir Henry refused to comment on the current performance of Fonterra.
Join NBR's intelligent business network today. www.nbr.co.nz/subscribe. NBR.
In market news, meat processor Silver Fern Farms has suspended trading in its shares on the unlisted market. The announcement was made in a brief media statement this morning, saying the board of Silver Fern Farms has elected to suspend trading in its shares on unlisted until further notice as it continues to progress its capital raising initiatives. It said no further comment would be made. Silver Fern's ordinary shares last traded on unlisted at 35 cents, well down on their $1 issue price. The company is in the late stages of a process to raise external capital to ease the pressure of persistent high bank debt on its balance sheet. It's understood that it received several final proposals this week and that it's due to decide on its preferred option by the end of the month. Options are believed to include selling its beef processing business or selling a controlling stake to an overseas investor. In a note to shareholders last month, Chairman Rob Hewitt said the capital raising process was continuing, and although the co-op initially thought it could announce something in June, that was now more likely to be July or August. Silver Fern is also required to hold a special meeting over a potential merger with Alliance Group after Otago farmer Alan Richardson gathered the required 5% votes to force the meeting. Disgruntled Alliance shareholders, led by Jeff Grant and Gay Cowie, have similarly gathered sufficient votes to force a special meeting of Alliance to discuss the same issue. But Mr Hewitt has said the company has had previous inclusive discussions with Alliance and the board felt it best to continue its quest for new capital. Alliance Chairman Murray Taggart said this week that for any merger to proceed it needed two willing parties who are profitable, have strong balance sheets, certainty around livestock supply and are operating in a stable growing business environment. He said Alliance was meeting again later this month with the meat industry reform group, Meat Industry Excellence, to discuss its proposal for a new export meat cooperative which would merge Alliance and SFF. But based on current information, he said the board's view was that the size of the merger prize identified by MIE's consultants, GHD, was unrealistic. On July 17, Silver Fern said it sold its 50% stake in rendering company Farm Brands to its joint venture partner Modena Investments. Chief Executive Dean Hamilton said the sale continues the process of simplification of our business. He said we want to focus our resources and energy on executing our differentiated plate to pasture-red meat strategy and in areas that aren't core to that ambition, partnering with specialists to achieve the best outcome. To Christchurch. Christchurch may not have its new conference centre yet, but it continues to host conferences in several venues. It's just won a bid to host the 2018 Steel Structures and Seismic Areas International Conference. Christchurch and Canterbury Convention Bureau and Tourism New Zealand Business Events made a successful bid which was presented by Dr. Gregory McRae from the University of Canterbury at the 2015 conference in Shanghai last week. The three-day conference, held once every 3 years, will attract roughly 300 mostly international delegates to Christchurch in February 2018. The venue is yet to be confirmed, but organisers will use either the Air Force Museum at Wigram, the transitional cardboard Anglican Cathedral, or Ridges Hotel in Latimer Square. Each has capacity for 300 delegate conferences. Dr. McRae says New Zealand is well known for its earthquake engineering and low-damage construction techniques, and Christchurch has a wealth of experience to share with international researchers and practitioners in this field. The Department of Civil and Natural Resources Engineering at University of Canterbury has gained worldwide recognition for its extensive theoretical and experimental research in the behaviour of steel structures. Dr. McRae says Christchurch is a living classroom and a rare example of a city where we have both steel structures and earthquakes. He says we'll be able to tour the city talking about the practical issues and a first-hand experience to help advance global research about seismic design of steel structures. Let's talk trade. New Zealand posted its first trade deficit for a June month in 6 years as imports rose more than expected. Stats New Zealand said the country had a trade deficit of 60 million in June, its first deficit for the month since 2009, and contrary to economist expectations in a Reuters poll for a 100 million surplus. It compares with a $240 million surplus for the year earlier month and a revised $371 million surplus in May. Imports in June rose 9% from the year earlier to 4.29 billion, even though the year earlier month included a large gain from the importation of an aircraft. That's ahead of the 3.95 billion expected in the Reuters poll. The increase in the latest month was led by a range of consumption goods from China, such as clothing, and machine and plant from China, such as mobile phones. Exports in June gained 1.3% to a record for the month of 4.23 billion and ahead of the 4.09 billion expected in the poll. Increased exports of logs, meat and fruit outweighed declines in shipments of milk powder, butter and cheese. The annual trade balance widened to a $2.85 billion deficit from a revised $2.55 deficit in May, and compared with a $2.7 billion deficit expected in the poll. It's the largest annual trade deficit since the year ended July 2009. Exports to China, the country's largest trading partner, increased 2.9% in June compared with the same month a year earlier, as gains in exports of logs, meat and fruit outweighed declines in the whole milk powder, according to the agency. International Statistics Manager Jason Atwell said when we compare the same months a year apart, this is the first monthly increase in exports to China since August 2014.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
To the NZX is working to launch fixed income exchange traded funds for investors and is also considering developing a currency hedged option. The stock exchange operator is fast boosting its ETFs to take advantage of growth in the New Zealand funds management sector, which is expected to increase at an annual rate of between 10 to 15% over the next 10 years, partly due to KiwiSaver. NZX announced on Wednesday it's launching 9 global equity ETFs next week to join the 10 funds already operating. The ETFs invest in index tracking underlying funds run by a mutual fund company, Vanguard Group. A spokeswoman says next to launch will be fixed income ETFs, which are currently being developed. The NZX is also looking at developing currency hedged ETFs. However, the spokeswoman says unhedged ETFs do remain popular around the world, and we expect that to be the case in New Zealand also. We did consider a hedged and unhedged version of each fund, but that is very difficult to do cost effectively for our investors. She says the current mix is about providing options, and some ETFs will suit some investors better than others. We would encourage each investor to consider their risk profile as part of developing their investment strategy, and for that many should consider some level of financial advice. According to the new ETF's prospectus, fees to NZX are 0.3% a year for the S&P 500 fund and 0.45% for the rest of the funds, from which all expenses are paid. Underlying fund expenses are to be paid on top of that. The spokeswoman says the funds are not necessarily better value for money than US-listed or ASX ETF equivalents, but they represent an investment in convenience. When looking at the total cost of administering offshore investment, she says, the Smart Shares offer will be compelling for many investors. Most will be drawn to the convenience of NZX-listed products traded in New Zealand dollars that provide easy exposure to the global markets. She went on, they can avoid dealing with dividends in foreign currencies and administering foreign exchange transactions, and do not have to worry about preparing foreign tax filings. On top of that, they will benefit from all Smart Shares funds being PIEs, which caps the tax rate on dividends at 28%. A recent NBR subscriber poll shows 59% are considering investing in the new ETFs, while 41% say they're not interested. Let's talk rich listers and their driveways. A judge says a novel multi-million-dollar squabble between an NBR rich lister and his neighbour, a former rich lister, over a humble gate is without precedent in the common law world. Former Metropolitan Glass founder Cameron Gregory and former Advantage Group chairman Evan Christian own neighbouring multi-million-dollar North Shore properties, which stretch down a shared driveway from the road to the Hauraki Gulf. Mr Gregory has filed an application for orders enforcing or modifying right-of-way easement against 2 entities linked to Mr Christian, EK Trust and Christian Family Trust. Mr Gregory's home is valued at $3.75 million and is in the middle of a shared driveway flanked by the waterfront EK Trust home valued at $8.65 million and the roadside Christian Family Trust's $1.825 million property. The matter first came before the courts in April, but further details of the neighbours' at-war dispute emerged before Justice Sarah Katz in the High Court at Auckland yesterday. Mr Christian bought his 2 properties in 2013, after which he removed a gate at the top of the shared driveway. But Mr Gregory wants a court order reinstating the gate, with the backing of a 4th property owner whose $2.05 million home shares the driveway and was recently broken into, Dean Revell. Mr Gregory's lawyer, Harry Walkins QC, says the earlier owners of properties on the driveway had installed a gate 25 years ago. The section was previously home to a hospital from 1962, but when easement rights were first established, the ownership of the driveway was notionally split in 2 while granting mutual rights of way. Mr Walkins said it's a relatively common easement without which the driveway would not work and the gateway is completely in keeping with its terms. He says Mr Gregory was simply adapting to improvements of the age in wanting to reinstate the gate. They, EK Trust, want to place a gate, they just want to place it further down the driveway. But Justice Katz says she's struggling with the proposition of a court holding that a dominant tenement owner, that is the one gaining the benefit of the easement, putting a gate across someone else's land. She says normally someone puts up a gate which someone else wants taken down, for which there are hundreds of cases. Mr Gregory's application, however, is novel in the common law world, she says. The hearing continued yesterday afternoon with both parties present in court. Mr Christian's interests are being represented by David Chisholm, QC. In market news, Carpet Court shareholders are upset to lose money as the ailing retailer is sold off to an Australian private equity fund. As first reported in today's National Business Review print edition, Allegro, an Australian fund manager which specialises in turning around troubled businesses, is putting the finishing touches on a deal to buy the struggling flooring retailer. Sources close to the company say there was a better offer on the table, but this fell through, and creditor Westpac Bank, owed about $20 million, is keen to see the business go to Allegro quickly. NBR Radio understands that while Westpac and another creditor, CBA, owed about $10 million, will be paid, Carpet Court's 37 shareholders will be left out of pocket. Paul Derbyshire, who sat on the Carpet Court board until a radical shake-up in 2008 after Rodney Martin took a controlling stake through his investment vehicle Lincoln Capital Partners, says, "Naturally, I'm disappointed to have lost money." The former Carpet Court Central Regional Manager, who owns 274,000 of Carpet Court's parent company's shares for a 1.24% stake, still does contract work for the business. He's upset at the lack of information and discussion with stakeholders about the deal. He said, "Apart from a phone call from Rodney Martin, I haven't received any other information about it, which is disappointing, and not being consulted about it is a bit of a kick." Giving me the bad news, Mr Martin said he was sorry, but they had to sell and get out, and he was sorry that our value was nil. That was a shock to me, especially since we'd been hearing that the company was doing well. Carpet Court, which has more than 50 branches around New Zealand, is owned by Flooring Brands, Australasia's largest flooring group. Flooring Brands was founded in 2004 by Mr Martin, who gained control of the Carpet Court Cooperative in 2007 by notching up ownership of 32 of the 61 stores. At the time, it's understood he paid former Carpet Court owners 60% cash and 20% more if the store reached its earnings before interest and tax target over 3 years. The last 20% was to be paid out when Carpet Court listed or sold.
NBR Radio. Free to air online with business news you can use.